Hi, I'm Rick Kaler. Thanks for joining me. Ever since Stephen R. Covey published the 7 Habits of Highly Effective People in 1989, we've seen variations of 7 successful habits on just about everything. So here's my version as applied to investing. Number 1, start early and invest regularly. Successful investing takes time, and there is no magical catch-up strategy if you start late. So many people make big investing mistakes by waiting, and then in a panic start swinging for the fences in order to try and make up time. That strategy rarely works. Some don't start early because they believe they need to be making a lot of money before they start investing. They assume investing $10 or $20 a month isn't going to get them anywhere. I would suggest that nothing could be further from the truth. It just takes time to see the results add up. I started with $20 a month when I was in my early 20s. It took me 10 years to accumulate $4,000. I was convinced that I was going nowhere fast, but I stuck with it, and I was able to gradually increase my monthly investment amounts. And today, that $4,000 has grown exponentially and will provide me a comfortable retirement income. Number 2, compulsively diversify. Yes, this is an area where compulsion, I think, serves you well. One of the cardinal sins of investing is putting all your eggs in one basket. It's a recipe for disaster to stake your financial future on any one company, commodity, or investment strategy. I'm suggesting it's ill-advised to place a large portion of your portfolio into gold, oil, real estate investment trusts, or the exciting stocks du jour, which right now are Microsoft, Apple, Amazon, Tesla, or any other asset class. Savvy investors own lots of eggs in lots of baskets. What's that mean? Thousands of U.S. and international stocks are in their portfolio, from super small micro-cap stocks to the super large companies. They'll own scores of real estate investment trusts with properties scattered all over the globe. They invest in diverse worldwide corporate government, inflation-adjusted, and high-yield bonds. They also own gold, oil, lean hogs, and a dozen more commodities. Basically, a diversified investor through mutual funds and ETFs owns a little bit of about every investment there is. Number 3, embrace boredom. Successful investors don't try to time the market by buying low and selling high. The research is stacked against you. They have realistic return expectations. And now what's that? Well, most will understand that they'll provide themselves a pretty good retirement if they can average 1 to 3% above inflation over a long period of time. So with inflation at 1% today, you want a return of 2 to 4%. If inflation was 3% over a long period of time, you want 4 to 6%. So they'll set an investment strategy with realistic returns and then stay the course. 4, they'll take age-appropriate risks. Young investors with decades to recover from market volatility may start with 100% in stocks. Then they'll readjust their allocations as they age and their lives change, gradually diversifying into other, perhaps more conservative asset classes. For example, like bonds or alternative investments. They'll understand that volatility is normal, and they expect their portfolios to fluctuate, sometimes wildly, as we saw this March. And then they rebalance their portfolios once a year. Number 5, which kind of follows on that, seldom look at balances in markets. Research shows that the investors with the highest returns look the least. Effective investors don't pay attention to the financial news of the day. They do pay attention to their emotions, especially those generated by the financial news of the day. They never make adjustments to their portfolios when feeling anxious, fearful, or euphoric. Number 6, focus on taxes and fees. Unlike markets, taxes and fees are something that you can control. They use retirement accounts. They pay attention to gaining or taking their gains and losses at strategic times. They take advantage of the 0% capital gains bracket when they can. They know the overall expense ratio, that's the fees of their portfolio, and they know what they pay for financial advice. And finally, number 7, ask for help in the right places. Successful investors know when they know enough to be dangerous. They know the difference between fiduciary advisors and sellers of financial products. They know the difference between a fiduciary advisor and one that has a conflict of interest. They seek help from advisors who are educated, unbiased, and free of conflicts of interest. Thanks for joining me.